Alright, wunderschönen guten Morgen hier aus dem Herzen von San Francisco, aus dem Coworking Space, in dem unser Büro beheimatet ist, dem Galvanize. Mein Name ist Daniel Sawaczynski und ich bin der österreichische Wirtschaftsdelegierte der Wirtschaftskammer Österreich hier in San Francisco und auch gleichzeitig Direktor von Open Austria. Open Austria ist eine Initiative gemeinsam zwischen der Wirtschaftskammer Österreich und dem Bundesministerium für europäische und internationale Angelegenheiten. Und bereits seit 6 Jahren gibt es unser Büro hier in San Francisco, das speziell darauf ausgelegt ist, österreichischen Startups und Investoren Zugang zum Ökosystem hier an der Westküste und besonders in der Bay Area zu geben. Teil unseres Auftrags ist es ebenfalls, österreichischen Unternehmen auf der Suche nach neuen technologischen Trends zu unterstützen. Und zu diesem Wissenstransfer gehören eben auch interessante Veranstaltungen wie die Webinarserie, mit der wir uns heute beschäftigen. Willkommen damit zum allerersten GoUSA Startup Talk. Das ist eine Serie, die wir als Fortsetzung unserer als Ergänzung unserer GoUSA Startup Landing Zone ins Leben gerufen haben. Sie haben vielleicht von unserer vormaligen Initiative, dem Go Silicon Valley Programm, gehört, das es bereits seit 12 Jahren hier in San Francisco gibt und mit dem wir über 170 Startups hier nach San Francisco und in Silicon Valley für ein Programm von 6 bis 12 Wochen gebracht haben. Dieses Jahr zum allerersten Mal wird dieses Programm oder erstreckt sich dieses Programm auf neue Standorte und wir haben es in eine GoUSA Initiative umgewandelt, gemeinsam mit unserem Partnerbüro in New York. Und zum ersten Mal können österreichische Startups sowohl nach San Francisco als auch New York und nach Boston für ein Programm von 4 Wochen gesendet werden. Innerhalb dieses Programmes werden dieses Jahr 20 österreichische Startups, die bereits zum Großteil ausgesucht sind, dazu komme ich später noch einmal, für 4 Wochen an die Standorte geschickt und gehen durch intensive Bootcamps mit Workshopleitern, Coaches, Mentoren und werden hier in die jeweiligen Netzwerke und Ökosysteme tief eingesetzt. Und wenn wir von Partnern sprechen, when we speak about our partners, I'd like to switch to English now and introduce not only our partner for this year's GoUSA Silicon Valley program, but also the speaker of our very first startup talk, Steve Hoffman, the CEO and chairman of Founderspace. It's great to have you with us. It's great that Founderspace has been once again a partner of the GoUSA Go Silicon Valley program. Steve, you are an investor, you're an educator, you are a founder yourself, you've seen the ecosystem from a variety of angles. So I think you are the most perfect person to kick off our series today. So I'm very happy to have you on board. You've also worked, I think, Founderspace partners with more than 50 companies, organizations in 22 countries. So you've worked a lot of European startups. So we are very excited having you on board here and kicking off our first startup talk on raising capital in Silicon Valley as a European startup. Thank you for having us. Thank you for being with us.
Daniel, it's fantastic to be here. I am very happy to be talking to all of you. And today I'm going to talk initially about raising venture capital from a European perspective. So for what European startups need to understand about raising venture capital in America. So I am the chairman and CEO of Founderspace, but in Silicon Valley, they call me Captain Hoff. So Captain Hoff is my nickname. You can call me Captain Hoff when you come. And I have been a startup founder for years. In fact, all of our instructors at Founderspace have been startup founders. I personally have done 3 venture-funded startups in Silicon Valley and 2 bootstrap startups. So I know what it's like to be an entrepreneur. And I sat on both sides of the table. I've raised, tens of millions of dollars in capital for my different companies. And I've also sat on the side of the table as the venture capitalist, because now I invest in startups. So what I'm going to show you is an inside look at venture capital and what you need to think about in order to be successful in raising capital. But before I do, I'll tell you a little about Founderspace. So Founderspace has been around over a decade. We are headquartered in Silicon Valley, but we work all over the globe. We've worked in over 22 countries around the world with different government partners, large corporations, and tech parks. And we have specialized in helping overseas startups like yourselves actually enter the US market. So that is what we do. Founder Space was ranked by Forbes magazine as the #1 accelerator for overseas startup. Entrepreneur magazine gave us the same ranking, and Inc. magazine put us in the top 10 incubators. I am also author of several books. So my first book, Make Elephants Fly, is all about the process of radical innovation. So the elephant is your big idea, and it's how you bring that to market. My second book, Surviving a Startup, is exactly what the title says. It explains in detail everything as an entrepreneur you need to know to survive and grow your business. And as you know, most startups fail. So there's certain key learnings that I've learned myself in doing all my companies, but I've also learned through helping hundreds of startups around the world overcome obstacles, what they need to do, how they need to go about it, and the mistakes that people make. And lastly, the 5 forces that change everything. This book is about how new technologies, emerging technologies, are going to reshape business, our lives, and the future. So technologies like AI, nanotech, CRISPR, gene editing, brain-computer interfaces, virtual reality, how each of these different technologies is poised to change how we interact with the world and each other. Now I'm going to start with raising capital in Silicon Valley as a European startup. And let me tell you, we're going to have Q&A at the end of this session, so you can ask me personal questions that you have. What I'm going to give you is some of the insights into how venture capital works in Silicon Valley. So #1 thing you need to understand is investors in Silicon Valley and in America in general, it doesn't matter if you're in Boston or New York, I'm talking about venture capitalists. Venture capitalists want elephants. They don't want mice. They don't even want, tigers or gazelle. They want huge deals. By elephants, I mean they want fund makers. Now, most venture capital, in order to pitch a venture capitalist, you need to understand their business model, not just your business model. Their business model is a hit-driven business. It's like the movie industry, where one movie can gross enough money to pay for all the losers. In the venture capital world, typically a venture capitalist has a portfolio of startups, and usually out of that entire portfolio, which can be 10, 20, 30 startups, usually only a handful, sometimes 1 or 2, make almost the entire fund. They literally return the investment for the entire fund. They dwarf all the other investments. So when venture capitalists are looking at your company, they're not looking for an easy win that isn't big, like a moderate win. If you pitch them a moderate win, most venture capitalists are going to say, that's nice, but no thank you. Why would they say this? Well, they're going to say it because even if your company has a high probability of becoming profitable, as making money, that's not their model. They want your company to grow exponentially. They want every time they make an investment that it has a chance to become the next Google, Facebook, Twitter, Microsoft, the next huge company. That is what they're going after. And if they can't see that in your pitch to them, then they will probably say no, because it just doesn't work. Now, even angel investors, and I'm talking smart angel investors who come in at an early stage, are looking for the same thing. Why do they want these elephants? Why do they want these big wins? Well, let me tell you why. #1, I'm an angel investor. You could come up and say, look, give me money. I'm guaranteed to make a profit. In fact, we can, this company will grow 10x in the next year. I guarantee it. 10x isn't enough. Like, if your company is going to grow 10x and then level off and not keep growing at a fast rate, they don't want in. Why wouldn't they want in? Well, #1 reason is because it's hard to exit. Any company that isn't continually growing is a really hard company to sell or IPO. So if a company makes a lot of money and then peaks and either levels off or trends down, it's, in terms of getting an exit, becomes exponentially harder, extremely hard, because big corporations want to buy companies that are in a growing market. If you're a company that's profitable, but you're not going to return it, think about it. You're Google, you're Microsoft, you're any big corporation that is acquiring potentially a startup, you're going to look at a startup that will become a key part of your business. And a key part of your business, if that startup has leveled off at making $30 million a year, that's a rounding error for these big companies. It doesn't make it won't do anything for them. So they're not going to acquire you. And also, no investment bank is going to take you public because you don't have the growth potential. So it's all about exponential growth potential. Remember this, they need big wins or they're not going to come in at all. You need to find a totally different type of an investor if you're going to invest in a slow growth traditional business. Your business has to be hyper growth. That's the rule. Number 2, sell the future. So when you are pitching investors in America, venture capitalist investors, I'm not talking other investors, but really venture investors or angel investors that come in before venture investors. When you're pitching these investors, they don't care as much about what you are today. So a lot of entrepreneurs make the mistake, and I've seen it. They go in and they do a lot of explaining about what the company is now. That's good. The investors do need to understand what you're doing now, but you need to make sure to spend a good portion of time about describing to them what you will become, because that's what they're investing in. They are investing in you as the giant company. So when you do your presentation, up front, you need to put what they really care about, and I'll tell you right off the bat. Number 1, they care about what is your business, like who are your customers, why do they absolutely need your product? That's number 1. Number 2, the next thing they care about is, how are you going to make money? How is this money going to grow? Show me how this money is going to grow. And then number 3, which a lot of people don't spend enough time on, show me the future. Show me in 10 years what your company is going to be like. How is it going to change your industry? How is it going to transform everything? How are you going to become the dominant player? Because if you're not going to be the dominant player in your sector, if you're just going to be one of many, it is going to be extremely hard for you to accomplish rule number 1, which was become an elephant. Only dominant players are the ones that grow exponentially. Dominant players usually take most of the market. And you can look, this is true across all businesses. Like, it doesn't matter what business. There are economies of scale, there's the network effect, there's all these different factors that mean whoever becomes the dominant player is very hard to displace, and they usually gobble up market share. So your future, when you are showing them the future, you are showing them the potential to become this, how you will become this. And when you show them the future, I want you to make it visual. Don't just show them some numbers on a slide. Don't just show them a graph, a hockey stick graph that goes up. That's not enough. When you show them the future, you need to show visuals. Like, what will your products look like in the future? How will your customers use those products in the future? You might not have even built these products yet, or you might have a current product line, but what will the product line of your future look like? Imagine that. Your entire presentation, when you're giving it to them, has to be visual. It can't just be text. People don't, if I'm presenting now, like, look at my slides. How many words do I have on this slide? 3 words and 1 number. I have 3 words, sell the future. And I have a picture. When you are presenting to investors, you need to do the same thing. They want to see what your company is going to become, visualize it, not just read it in a bunch of text or see a graph. Number 3, know your valuation. So this is a tough one for European startups. So a lot of startups come from Europe and they're like, how do I know my valuation? Like, how do I know what I'm worth? I kind of know what I'm worth in Europe, but in the United States, what am I worth? Well, let me tell you. First of all, knowing your valuation is tricky for everybody. It's tricky for even me, and I'm experienced at it, because valuations aren't constant. They are always changing. First of all, your company is changing. Every month your company grows, time passes, your valuation hopefully goes up, not down. Also, your location matters. what your valuation is right now in Europe is not the same as what your valuation will be when you come to America. You have to remember this. Valuations are kind of like housing prices. You can take the same house and have it in the city of Vienna, and then you can have the same house in the countryside, exactly the same house. It's going to be a totally different value. If you take the same startup in Vienna or any other part of Europe and you move it to New York, Boston, Austin, Texas, Silicon Valley, it's going to have a different valuation in each of those cities. And the valuation will be determined by one thing: competition for deals. Competition amongst venture capitalists for deals combined with the actual value, perceived value, because nobody knows what your company is worth. It's too early, like your company is too early. The perceived value of your company based on your potential. So those two things come into play. And what investors do is they'll rank your company, usually in their mind, against all the other companies they're seeing. And every investor knows, because they're competing for deals, what valuation companies are getting at. And I will tell you, right now, valuations have changed. Like if you go back just 12 months from now, 1 year, valuations were much higher in Silicon Valley than they were before. But as you probably know, the stock market took a dive, especially the tech sector. Venture capitalists became very conservative. A lot of venture capitalists are telling entrepreneurs now, cut your value by 50%. Now, this isn't such a bad thing. Valuations in Silicon Valley, New York, around the world were extremely high a year ago, extremely high. Now, valuations have come back down to more like what they should be. Valuations aren't low today, so your valuation is still reasonable. It's just at a much, there's less competition for deals because investors are holding back. They don't quite know where the economy is going. They're being conservative, but they are still investing. Now, this is the good news. Investments in venture capitalists, in the United States have raised huge amounts of capital, and they have to place this money in startups. So when you raise a $100 million fund or a $500 million fund, you are committing to your investors, your LPs, limited partners, that you will place that money in startups, usually within a 3-year period. So there was an enormous amount of money raised, and now they have no choice. They have to either place this money or give it back. Some VC firms, not the top tier, but some of the lower tier VC firms, the ones that don't have as great a reputation, some of their investors did not re-up their money. So they do what are called capital calls. And when the stock market, the tech market tanked recently, some of the capital went away. They said, no, we're not going to put our next tranche of investment in your fund. So those funds are hurting, and they may not be investing. But the top tier firms, they have their money and they're going to place it. So if you have a good company and you're coming to Silicon Valley today, I will tell you, if you have a great company, there will still be competitive, there'll be a lot of competition for your deal and you'll get an excellent valuation. If you have a good company, not a great company, it's going to be more of a struggle. Because the great companies, like everybody goes to the great companies, why wouldn't you? And then the good companies usually have to work really, really hard to raise money. So when you're thinking of your valuation, how do you determine it? I'm getting back to the main question. You have to go into the market and ask investors. You have to, I can give you a rough estimate of your valuation. Other experienced people can give you a rough estimate. But the only way you'll know for sure is to go into the marketplace and start seeing what companies are closing at. You can do this. One good way is if you can get onto AngelList, and if you sign up to AngelList as an investor, you can actually look at the values of all the companies on AngelList, and you can start to see similar companies and what their value is and compare it to yours. You can also go to people in the industry and talk to a lot of people. You can go to venture capitalists and say, look, you might not even be raising money. I'm not raising money now, but I want you to give me an idea of what you think my company is worth. Another great source, lawyers. Lawyers, especially the top lawyers in places like New York, Silicon Valley, Boston, places like that, the top lawyers, they see the deal flow. They negotiate these deals. They even negotiate the valuation. So they're actually the best people to talk to about valuation. So if you have a really well-connected lawyer, not only can they connect you with venture capitalists, but they also have great deal flow, and they can actually tell you, oh, I've seen all these deals, you're probably worth this, or you're overvalued. Now, let me give you one story, a cautionary tale for you. A cautionary tale is I had a startup come to me, and that startup, they had an incredible product, incredible vision for their product. They hadn't built it yet, an incredible vision. They had all laid out. They'd done everything right. The team was excellent. They had sold a company to Adobe before, really good team. I looked at them and I said, I think your valuation is high. They were asking for 15 million pre-money, and that means $15 million valuation before the venture capital comes in. So they are asking for 15 pre. And at the time, I said, you're too high by a factor of 3. I think you're worth 5 million pre-money. You're not worth 15. Well, they said, no, we are worth 15. I know we're worth 15. So I said, okay, I'll introduce you to some investors, go out, talk to them, see what they say. Sure enough, the investors came back and said, you're too we want to invest, but you're too high. They refused to lower their valuation. Literally, I stopped introducing them to investors because it was a waste of time. A year and a half later, they came back to me and they're like, oh, we finally closed our round. We finally closed our round. And I'm like, what did you close it at? Oh, at 5 million. This was a year and a half later. They could have closed it at 5 million when I told them, but they were extremely stubborn and they had to learn the hard way. When you get feedback from the marketplace, not just me, I'm just one person. No one person knows your valuation. You get a lot of different data sources. When you get feedback from the market, from enough sources, take it and don't waste the time, because time is opportunity. Number 4, know your competitors. A lot of entrepreneurs make this mistake. They spend too much time on their own product, on pitching investors, on building their team, on preparing their marketing. But what they don't spend nearly enough time doing is knowing their competitors. Who are their competitors? And when I say know your competitors, I don't mean just put up a little chart on your investor deck showing your competitors and how you're better. Everybody does that. And we know as an investor, when we see those charts, that you're just showing part of the picture, the things that make you look good. What you need to understand, if you're going to run your business, is everything about your competitors. You need to know every detail of your competitors. What is their product? Have you used their product? If you're coming to work with me, one of the first questions I'm going to ask her is describe your competitors in detail. And I'm not talking superficial stuff. I want you to have spent literally weeks on end using your competitors' products, understanding what your competitors do well, what they don't do well, why are you better? What is in your customer's mind? Why would a customer choose you over these competitors? And you can't know this, and you have to understand your competitors are innovating all the time. If they're good competitors, and I'm sure people tell me I have no competitors. If somebody says this, well, they're living in fantasy land. Everybody has a competitor. They may not have exactly the same product, but somebody is doing what you want to do in some other way. And you need to understand that entire process, because only if you understand this can you ultimately build a better product. So as an investor, when I look at an entrepreneur, I want to see that entrepreneur, understands the competitors' products as well as their own. And they have really, they have become a power user of their competitors' products or services. This is so important, and it's something a lot of entrepreneurs, I'll tell you, probably 80% of entrepreneurs don't spend enough time on. That's why I put it as number 4. Number 5, you need data, and you need it because investors need it. You can paint a huge vision about how you're great. You can do everything correct that I've said so far in the perfect way, but really smart investors understand that visions don't always translate into reality. What you're describing may sound great, and it may look great in your PowerPoint presentation, in your business plan, but reality is always different. So what really smart investors are looking for is, can you prove your thesis? Can you prove that what you're telling me is true? How do you know it's true? I want to see data from customers. And you may say, well, I'm a little early stage, I don't have a lot of data. Well, that's no excuse. Even if you haven't launched a product or service, you can get data. And whoop, it just went crazy again. Why did that happen? Okay. Let me go back. Okay, 1 second. Sorry to interrupt this. Okay. Can you see it? Okay. We're back in action. Let me change the display settings again. Duplicate slideshow. Okay. Investors need data. So what type of data do investors expect to see? Investors need some proof. So I was saying, even if you're an early stage startup, you can generate this proof. First of all, let's say you don't have a product yet that's on the market. You're still developing your product. You can actually put up a landing page. You can use Google AdWords or Facebook to target the exact customers that are after your product. You can drive them to a landing page. The landing page can look like the product is completed. You can have videos, you can have graphic images, and then you can have a button, a buy me button. And you can have potential buyers, your exact target, click on that button. Now, when they click on that button, because you don't have a product, you would say product coming soon, enter your email address. But what you're measuring is not, you're not trying to gather email addresses. What you're really trying to do is measure customer interest. So what percentage of the customers that come to your landing page actually click the buy button? And then what percentage of those customers actually enter their email address, or even better, do an advance buy like on Kickstarter or Indiegogo, where they buy it in advance. This is real data, and you don't have to have a product to do it. If you're a B2B company, you can get real data by going to your customers, going to them and actually presenting your product, the vision of your product, and asking them if they want to come on early as testers. If you can get these potential customers to sign up as early testers even before you've launched your beta test or your alpha test, that's proof to investors that customers are interested, because they wouldn't be signing up if they weren't interested. Even better, will they write you a check? Are they that interested that they will pre-buy your product? The businesses pre-buy it. Or will they sign a letter of intent if you're doing big corporate sales? Will they commit to buying it in the future? Any of these are great data points. Data point can even be as simple as doing basically customer interviews. So let's say you are planning on selling into Fortune 500 companies. Can you get in front of the key buyers at these companies and videotape them? Say, look, I want to get your feedback on our product, and actually have them describe why they need your product. You can describe it in your own words, but there's nothing like an investor hearing it in the words of your customer. So these customers don't have to be in America. You can get them while you're in America, great, but start with customers in your home country. So in Austria or wherever you are in Europe, start with these customers and actually get them to give testimonials, to run tests, do as much of this data gathering before you come to the United States as possible. And then you can do more when you're in the United States. And you can even do this data gathering of US customers, because the web is global. You can market to US customers while you're in Austria, and actually get these customers to click through and gather data and give you their email addresses. All this you can do in advance. And the more you do, the better position you will be in to raise capital. Number 6, seek advice, not money. This is really important. A lot of entrepreneurs I know are laser focused on getting money, especially when they're meeting investors. But I'll tell you, money it's great to get money, but if you go into an investor pitch and all you're focused on is getting their money, you are missing a huge opportunity. So first of all, when you talk to investors and you're just trying to sell them on your company, that doesn't make a great impression. Like it's usually you're just trying to get their money and they know it. Investors, and I'll tell you this is the psychology of American investors. American investors and venture capitalists in particular, and angel investors too, they want to feel part of something. They want to feel like they're of value. They want to contribute to your company more than writing a check. So by actually engaging them and listening to them and asking what they would do if they were in your shoes, you will not only gain valuable advice, because think about it, these investors that you are speaking to or angel investors have been successful. A lot of them have started and sold businesses or started and taken businesses public. All of them have been seeing lots of startups in the space, investing, a lot of times mentoring. The advice they're giving you could be extremely valuable and could totally change the direction of your company. So when you're meeting with them, don't do all the talking. Actually ask them as many questions as they ask you. Get from them as much feedback as possible. And what you will understand is two things. Number one, even if the investor chooses not to invest in your company, you will walk away from that meeting with a lot gained, a lot of knowledge gained. And then number two, that investor will actually be more likely to invest in your company if you allow them to actually give you feedback. Because once somebody gives you feedback and they start coming up with ideas, they are becoming not just a detached observer of your presentation, but they are becoming involved. They are taking mental ownership of your company. So by seeking their advice, you are getting them to think creatively and buy into your company and imagine what your company could become. That makes them much more likely to invest in the future. Make it memorable. So number 7, when you give an investor pitch, don't just pull up a PowerPoint, walk through the slides, and then ask them for their money. Everybody does this. And let me tell you, especially when there's a demo day, a pitch day that you go up and present, and there's like, 10 other startups or 20 other startups in this demo day, it's easy to forget which startup is which. What you want to do is stand out from that crowd. You want, when those investors walk away, that they remember, oh my God, this startup is amazing. And how do you do that? Well, first of all, do something different, do something crazy. And let me give you an idea. So I'll tell you 2 stories. One story is there was a startup. Everybody else gave the normal 20-minute investor pitch or 5-minute, depending on how long they were, investor pitch at demo day. One startup I saw, and I see a lot of demo days, they went up there and they gave literally a 1-minute pitch. They held up a little product, and it was a little device, a tiny device that they could fit in their fingers, and they said, we have made this device, and that when you place this device behind your ear, it can totally change your life. Totally change your life. If you want to find out more about this device, come meet me. I'll be at the table. We have a booth at the back of the room. Come meet me after this presentation. And the entrepreneur walked off stage. That was it. That was their entire presentation. But let me tell you, every investor was at that booth after. Every investor was so curious about what this device did, and I'm not going to tell you. Every investor was so curious that they were at that entrepreneur's booth. That only worked because it was different. You can't, like, if every entrepreneur did that, it wouldn't work. But it was so different that entrepreneur caught their attention, and they remembered it at the end of the presentation. Number 2, another entrepreneur. He went in. He got a meeting with Tim Draper, and Tim Draper is one of the top venture capitalists in Silicon Valley. And when he got that meeting with Tim Draper, he was super excited. He was so excited. Like, he basically wrote Tim a cold email Tim responded and said, come in to meet me. But the guy was across the country and he literally had no money. And so he was like, okay, when do you want to meet? And Tim Draper said, Thursday, a couple days away. The guy told his team, we got to get the money. We got to get money for planes. They scrambled. They got the money. It was winter and it was snowing and their airport, local airport, was closed. So they had to drive like 2 hours to another airport, and they caught a flight. They caught an overnight flight, made it to Silicon Valley. This was their one pitch. Like if this pitch didn't work, they would be out of business. Now they were a music startup, so they were doing a music app, and they decided that they were going to make, they had this one shot to make an impression, and they were going to make sure that they impressed him. So what they did is they walk into Tim Draper's venture office on Sand Hill Road, and these offices are very conservative, they're very plush, they're very quiet. But they walked in, the four of them, the four founders walked in with a boombox, a big 1980s boombox, blaring music. They were all dressed in crazy outfits, and one of them was the mascot for their company logo. And they were dancing, and they just danced right into the main lobby. Went up to the reception. Where's Tim Draper's office? She was shocked. She was like, it's over there. They danced right into Tim Draper's office. They sat down and they gave a wild pitch about how their music company was going to change the industry. You know what? By the time they walked out of that pitch meeting, Tim Draper had written them a check for $400,000 US. He wrote them a check on the spot. He goes, you guys have something. Now, these two examples, these are real examples, real world examples, but you don't have to do either of these. I'm just telling you, if you make it memorable, your chances of getting funded are much higher. So put on your creative hats and do something special. Create competition. Now, this is a different type of competition than the one I talked about earlier. This is competition for a deal. So when you are going out for investment dollars, what I want you to think about is, how do I create competition? Because honestly, most investors don't invest unless they are under pressure. Why is this? Like a startup can walk into them and go, oh, I have this great company, and they can say all the right things, and the investor will think, oh, that's really interesting. But these investors, especially ones in big cities, in the big cities, the capital hubs of the US, like Silicon Valley, New York, Boston, these VCs are seeing lots of deals. So their modus operandi is, I'll see a deal, I'll wait, and unless it knocks me off my feet, and unless I'm under pressure to make a decision, I'll wait. So a lot of times they'll say, this is really great, and then they won't respond, or they'll say, come back later, or they say, come back in 3 months, you're a little early. They'll say all these things. I'll give you an analogy here so you really understand this. It's like the real estate market. Again, I'm going to go back to real estate. If you're in a house and the real estate agent tells you, you see a house, it's really lovely, it fits all your criteria, it looks like a great house, you could buy it, and the real estate agent tells you, oh, okay, I'm glad you like the house, get back to me when you're ready to buy it. You'll say, okay, well, let me look at some other houses and I'll get back to you. And there's a good chance you'll see another house you like better and forget about this house. But if the real estate agent says, look, I have other buyers who are coming in after you, this house is going to sell, and if you don't make me an offer, you may not get this house. If the real estate agent says that, all of a sudden you're like, you have to make a decision. You're like, well, if I walk out of here without making an offer, this real estate agent is going to be showing this house to a lot of other people, and it's probably going to sell. And if you really want that house, you're going to make that offer. It's the same in the venture capital world. If you are pitching an investor and you just say you have a great company and they feel like they can come back later and invest in you, no loss, they'll say later. So when you're in a pitch meeting, make sure to tell the investor in subtle way that you are really busy, you're seeing lots of other deals out, you're talking to lots of other investors, there's lots of interest, and that this deal won't be around. Like literally, you only need so much money, and as soon as one investor comes in, they could take the whole round, and the other investors won't be there. They need to believe that competition is there. And I've done this in deals. I've done it. I've literally said, you know, after this meeting, I have 3 other meetings lined up. You know, it's Sand Hill Road is where all the venture capitalists are. And I had 3 other meetings on Sand Hill Road, and it was true. And literally the investor gave me the term sheet that day. They put down the term sheet literally right after that meeting. That's how well this works. Fear and greed. So I'm going to emphasize this point again. The way to close a deal is to get the investor more afraid of losing the deal than they are afraid of losing their money. It's like a scale. Their fear of losing the deal has to be greater than their fear of losing their money. That's how you close a deal. And investors are greedy. They want big deals. They want deals that are going to not just give a return on investment, but deals that everybody's going to talk about, the big deals. They want to be able to put up a logo on their venture capital site of a startup that's gone through the moon that everybody's like, oh, you got in that deal early. So investors brag to each other. Like I know, I literally worked on Sand Hill Road in one of the top tier VC offices. I wasn't an investor at that time. My startup was being incubated by the venture firm, but I spent 9 months in their office, and I saw exactly how they think and exactly how they talk. So what I'm telling you is how investors operate. It's their mindset, their psychology. You need to understand this. Otherwise, it's going to be hard, because the entrepreneurs who understand this close the deals. My last one, kissing frogs. So number 10, the other way to close, the thing to remember is that every investor out there is like a frog, and every entrepreneur is out there going up to this frog, kissing this frog, and hoping this frog turns into their Prince Charming and carries them away and makes all their dreams come true. Well, we all hope that when we're entrepreneurs that that this investor will actually give us the money and get us started. But investors are like frogs. So if you kiss, my rule is, if you kiss the same frog 3 times and they have not turned in to Prince Charming, guess what? They're just a frog. So if this investor doesn't give you the money after 3 meetings, that's my rule, 3 meetings. Good deals close fast. Good, I've had investors that have dragged me along for 6 months when I was just beginning and I didn't know what I was doing. They dragged it out. They say, oh, come back for another meeting. Oh, get me this document. Oh, get me that spreadsheet. I want to see some progress. Come back when you have more progress. They keep talking to me, but they don't invest. They don't invest, number 1, because I couldn't create competition. Number 2, I kept meeting with them. You need to cut the meetings off. You need literally to say on your first meeting, the first time you meet with them, the first time you meet with an investor and kiss them, they're probably not going to turn into Prince Charming. They're probably not going to give you the money. So you need to say to them, I've given you the pitch. Is there anything else you need to make a decision? Or is there anybody else you need to me to talk to for you to make a decision? Most of the time they'll say, well, I want to think about it, or I need you to talk to this person or that person. What you do is a week later, you follow up, you literally say, you give them everything that they requested, and then you make sure that in your second meeting, whoever they need to make a decision is in that meeting. If possible, you do that. So you get that person in, you do the whole pitch again with the other person or the other people, and then at the end of that meeting, you say, are you ready to invest? If they're not ready to invest, you ask why. What is holding you back from investing? This is your second kiss. Again, if they either they're going to invest or they won't. If they don't invest, you say, well, I'm really busy, so you need to tell me like what you need so I can get it to you. And if you're not going to invest, you're not going to invest. You literally need to shut the door on them. So like if they aren't going to invest, you'd rather know after 2 meetings than have 5 more meetings and waste your time when you could be talking to 5 other investors with that time or building your company. A week later, you follow up with them. They say, okay, well, let's set up a meeting in a week. I'll get you whatever last things you need. And if there are more people you need me to talk to, let's get that done so you can make a decision. The third meeting, go through the same thing again, ask for the money. And literally, if they don't close by the third meeting, most likely they're not going to close. Because venture capitalists aren't like big corporations. Venture capitalists are usually lean organizations. They can make decisions very quickly, and they will get you into a partner meeting very quickly if they think they're going to lose the deal. they will do that. Same with angel investors. They're individuals. They can make decisions on the spot. Great deals close fast. And what I found is that exponentially, your chance of closing a deal on the first meeting, very low. Medium on the second meeting. Very high on the third meeting. After the third meeting, it starts to decline, and it declines exponentially. By meeting 5, 6, or 7, your chance of closing a deal is much, much lower. So when you're out there raising capital, push for a close on the third meeting. Sometimes you have to go to a fourth or a fifth meeting, but really understand that the longer you go, the lower your odds. And you are hurting yourself by giving your investors more leeway, because the more leeway you give them, the less urgent they think it is, and they get distracted, they're on to the next deal. Lastly, beware. Don't take in bad investors, right? So even if you feel desperate for money, and some startups do, others don't, really vet your investors. When you ask them questions, what startups they invest in. Most importantly, what bad startups did they invest in? Get that feedback, because that feedback will be very important. They aren't just choosing you, you are choosing them, and they are going to become your partners. It's like a marriage. You need to make sure that it's a good fit for your business, that your interests are aligned, that your visions are aligned. And careful what you wish for. I will tell you, this talk was all about raising capital, but some startups are better off not raising capital at all. Honestly, there are great businesses, like if you're a linear growth business, not an exponentially growth business, and if any of you startups come work with me, I will tell you what your business is. You need to understand what type of capital you need to raise, whether you should raise capital, what that means for your company, because again, if you raise capital from a high growth investor and you are not determined to make it a high growth, exponential growth business, it's going to be a misfit and it's not going to work. So those are my 10 rules of raising venture capital. And I will wrap it up by saying, if you want some other resources or materials, or you just want to reach out to me for any reason, you can go to foundersspace.com. There's a contact form. If you put my name in there, it will get to me. We also have lots of different videos and other things. And another way to connect with me is Daniel can connect you with me. If you talk to Daniel, he can give you my email address, or you can go to LinkedIn. Captain Hoff, search for Captain Hoff on LinkedIn. I'm the only one that comes up. You can reach me there. So thank you very much. And Daniel, I'll hand it back to you.
Thank you so much, Captain Hoff. It was, I think, a good 40 minutes of pure inspiration, and I think some really, really good practical down-to-earth advice within those points. And I think you've covered a lot of things that I experienced also in the last year being here in Silicon Valley, how Austrian startups approach the market and which things they should really consider and look at and to make it here. We'll quickly jump into the Go Silicon Valley program now. Before we start with the Q&A, right now there are no questions, but I invite all of you to post questions within the GoToWebinar interface. There should be a questions or Fragen part where you can post your questions. Right now, I just have a few people thanking you, Steve, for the great presentation. No questions so far, but then I would say let's jump and use the time into a brief description of the Go Silicon Valley. I'll take over from you and show my screen again.
Okay, yes. So great. So I will dive in here. In terms of Go, so we have the GoUSA program that Daniel conceived of, and it's in multiple cities now. So you can come to Silicon Valley, where I'm located, if you want to work with me. But for different businesses, different cities are better. So Boston is really big on biotech. New York is really big on finance. There's Texas, which is a thriving startup hub. There's all these different places. They each have their unique things. So do your research, do your homework, try to figure out which location is best for you. If you come to Silicon Valley, I'll describe our program, and I'm sure all the other programs, I'm not running all of them. Unfortunately, I can't clone myself and be in all places at once, but I will tell you what we're doing in Silicon Valley. The other programs pretty much mirror this. All the programs are pretty similar. So in Silicon Valley, we are really focused on a couple things. So number one, we want to get to know you. Like the whole idea of this program is that you're going to get lots of one-on-one time with us. You would get one-on-one time with me. You'll get one-on-one time with my partner, Naomi Kakubo, who has also done all, she runs Founder Space with me and has done all these, she's done a bunch of startups, worked with hundreds of startups. You will get our individual analysis of your business. You will also get mentors. So we, Advantage Austria, GoUSA is going to bring in a number of mentors in each of these locations. So you'll get mentors will be people from venture backgrounds. There'll be people from marketing backgrounds. There'll be people who work at big tech companies. There'll be lawyers. You're going to get lots of their feedback, their ideas on your business. You will also, if you come to Silicon Valley, get more of my talks. So if you want to hear me talk more, if you're not bored, you will definitely hear. I cover. We're going to cover everything. We're going to cover everything from how to put together a right business model and how to tweak business models, to going even more in depth on how venture capital works at a much deeper level, to talking about different marketing strategies, growth hacking strategies, talking about strategies for actually going to market in the US, how to sell into US companies, how US customers, their psychology works, all these different things. We have different seminars and courses planned out. So it's going to be a really intense 2 weeks, like super intense. You're going to be busy a lot of the time. So what we try to do is literally the mornings are free for you. We let you have the mornings open. So because we want you to do business, like we know you're doing business back home. We also know that you're going to want to arrange meetings and talk to people in Silicon Valley. So every morning you're going to have time for yourself to do that. And then in the afternoon, we run our programs. You would be expected to attend. So you're going to have to, you can't schedule your meetings in the afternoon. You only can schedule them in the morning, because we really want you committed, because we're committed. We're committed to making you successful. What we hope you walk away with at the end of the program is, it's great if you raise money, but the goal is not about raising money. The goal is about going to market in the US. The goal is about understanding whether your business is truly a good fit for the US market. And if it is a good fit, what obstacles do you face and how can you overcome those obstacles? The greatest thing startups can walk away with from our program is a much deeper understanding of their own business and how to take their business global, how to, what elements in their business work. And I'm going to be totally honest with you, like, and so will Naomi, like we are straight shooters. Like, we're not there to make you feel good. Our job is not to pat you on the back and say you're doing great. But if you are doing great and where you're doing great, we will definitely tell you, because we're friendly people and we want you to succeed, but we also want you to succeed. And that is why we are going to tell you things where we think that won't work from our experience, but you don't have to rely on us. Like, you're going to get our opinion. You're also going to be able to get the opinion of a lot of other people, a lot of our mentors. And so what you'll need to do is synthesize all this input and actually then take this knowledge and adjust. And I will tell you, the most important thing for an entrepreneur is to be able to do this, to not have these biases and these preconceived notions where you're shutting out advice. You need to come, whether you come into our program or any other programs, with a totally open mind, because it's the only way you're going to truly benefit. If you're like, because the best feedback we're going to give you is not the ones where we confirm what you already think. You're already doing it. You don't need that feedback. The best feedback we're going to give you is the ones where we actually challenge you. We actually say, is that really true? I don't know. I've dealt with startups in the past and I haven't seen that work. Prove to me that's true. Or, we're going to engage in a dialogue with you around those really tough issues. And that's where you're going to make the most progress. And let me tell you, if you figure out your business, and you will raise money, you will grow. If you don't figure out your business, it doesn't matter if you raise money, you will still fail. So we're going to try to help you figure out your business. That's our mission.
I think I couldn't have summarized any of that any better. I think now everybody got a great insight. Before we go into the question, just a few things for the timeline. So again, I mentioned there are 10 more days to be able to apply. We ask you, if you are interested, please apply with your pitch, with your video pitch, because we do not have time for another pitching competition that we did already in July, or actually in June. Once we select you by the end of the month, so latest on the 30th, 31st of August, you'll get a response whether you're in the program or not. On the 14th to 16th, we have a departure workshop in Vienna, where also Steve and Naomi are gonna be in Vienna in person to already get to know the entire cohort. And that's also where all the startups will meet for the very first time and then disperse to all the other locations. And then on the 26th of September, the Boston program starts. On the 3rd of October, the New York and San Francisco program start. We have 2 weeks of intense programs, as Steve already described. On the 17th of October, we have the demo day here in San Francisco, going right into the TechCrunch Disrupt, one of the largest tech and investor and startup conferences in North America, from 18th to 20th, also possible for our startups to participate. And then the last week, really focusing on the contacts you've built up and introducing you to the last few partners you might want or need. These are our contacts. In our office here in San Francisco, it's me and Natasha who are in charge of the San Francisco program, and Victoria is in the New York office dealing with the Boston and the New York program. So reach out to us if you have any other questions. And last but not least, we also organized 2 trips in the middle of October to the TechCrunch Disrupt. One program for startups. Even if you're not part of the program, you can still apply for a trip to TechCrunch Disrupt, where normally a ticket is almost $2,000. You get a great deal through us and get a 1-week program here in San Francisco focused on innovation and startups. And the second program is specifically dedicated to aspiring investors and institutional financiers, also built around the TechCrunch with a focus of really introducing to you how investment works here in Silicon Valley. Now we have a few good questions. Steve, are you ready?
I am absolutely ready.
Arne asked us, you said that hypergrowth is key, but more often than not, there is a predictable end to growth. See Netflix, for example, there's an end to how many subscribers you can get. So is this still a thing? Do you have to exit early enough? Do they plan on that as well? Get a lot of money out as you can as soon as possible?
Well, it depends how you look at it. Netflix has been around, what, a long time, over a decade. They've had a great run of growth. The market changed, right? So they would still be growing, but the market changed. A lot more competition out there. Disney moved in, all the big, HBO moved in on their turf. Tons of other providers became much more competitive. So that's what they're facing right now. In terms of growth, put it this way: venture capitalists care about, as soon as they put money in your company, what their most important goal is to get the money out of your company, but not to get out what they put in, to get out 10, 20, 100 times more than they put in. So they're looking for hyper growth all the way to an exit, an acquisition or an IPO, when they can sell their shares and return the money to their investors. That's their business model. Beyond their exit, once they sell their shares, they don't care, right? But the market cares. So great businesses, really, no business lasts forever. Like we've seen this. I mean, companies die. Like almost, how many companies are there around from 200 years ago, even from 100 years ago, even from 50 years ago? Businesses die, but great businesses continue to return money for their investors as long as they're innovating and changing with the times. So you look at Microsoft, still doing great. You look at Apple, still doing great. You look at Google, still making tons of money and growing. These are great businesses. Ultimately, that's what you should build. Like, I'm not telling you to just cash out quick and get your money and retire on some desert island. Build a great business. Build a business that adds value to the world. Build a business that's doing positive things. Build a business that you really care about. These are the important things. This is what Silicon Valley is supposed to do. Is give entrepreneurs a chance to do this, and a lot of times they do. A lot of times there's other companies that just come and go. So that's my answer.
Great. We have another question. What European values or behaviors are currently most appealing assets to Valley VCs, which we might not be aware of, in brackets?
That's a great question. It's I've never been asked that question. I thought I'd been asked every question, but not the one of European things that appeal to. So I think Silicon Valley VCs like a few things about Europeans. Europeans in general tend to be much more realistic than sometimes Americans, in the sense that Americans will hype things up, where a lot of Europeans, and you know it's hard to generalize, right? But a lot of Europeans are more down to earth. They'll tell you what's really going on instead of what you want to think, and that's refreshing. Investors actually like it. Nobody likes to be sold something that doesn't actually exist. Like, you have to do a little of that to sell them the future, but we also want people who are really practical about their businesses, who really understand their businesses inside and out. Europeans are really good at doing this. Europeans tend to be more socially conscious, environmentally conscious than a lot of Americans that we see. Or people from other countries tend to be less so, which is a great trait. And I personally wish Americans would be more environmentally conscious, but we have, and socially conscious. But we, there are different strains in our society that push different ways. Won't get into the politics of that. But the bottom line is, because of this, a lot of investors are investing there are a lot of investors in Silicon Valley now that are positive impact investors. So they really are looking for companies that will return a net value to society, not just companies that will make a lot of money, not just like the latest crypto guys who will sell a token and then walk away, and cash out with a lot of money, but won't really have created anything on the back end. We want companies that are building real businesses that offer real value to their customers and to society. And I personally am one of these. So when I'm choosing a company, I come in very early stages. I'm not a later stage investor. When I'm looking for a company, I'm looking for that. I know a lot of other investors who you will meet who are looking for that. Europeans tend to be more focused on this, although there are a lot of great American entrepreneurs too, but it tends to be a trait. Another thing is if you have a great European accent, that's always fun. So yeah, we Americans love that. In general, our view of Europeans is very positive. Like Europeans are very well received in the United States. I don't think you'll have any problem. Your English doesn't have to be perfect either, because over half the startups founded in Silicon Valley were founded by foreign entrepreneurs, the successful startups. So look at it, like it's not Americans who are starting these companies. Overwhelmingly, it's getting more and more and more. It's a global startup hub. That means we are open to entrepreneurs from everywhere, and especially Europe.
So moving on with my European accent to the next question. How to handle the seek advice part when being in a 5-minute pitching event? I understand the approach and think it's perfect for one-on-one pitching sessions and investor meetings, but cannot imagine how to do this in a pitching event and similar types of events. Do you have a recommendation for that?
So can you repeat the first part of that?
How to handle the seek advice part when being in a 5-minute pitching event.
Okay, yeah. If you're in a 5-minute pitch, like one of these startup demo days or things like that, you're not going to seek advice. Like, you're literally just giving a presentation. When I talk about seek advice, I mean you're on a one-on-one or you're meeting with a small group of investors, either over coffee or in their office or in our co-working space where you'll come and stay. You're meeting with them, and in those cases, a lot of times they'll ask you to give a presentation to them, but don't spend all your time giving the presentation. Make sure to engage them in dialogue. That's what I was saying. So it's that simple. And then even if you're at a big demo day pitch event, after your pitch, investors are going to come up to you. Don't continue to pitch them. Like, you've given them your 5-minute pitch. Let them ask you questions. Ask them questions. Get interested in them. That's where the magic lies. And remember that. So investors, like, I go to a lot of networking events too. You'll go to networking events in Silicon Valley. I encourage you. They're like every night. There's different networking events, and there are investors at these, there are other entrepreneurs, there are all sorts of people at these events. When you go to these events, don't just talk about your company. Don't just try to sell people on your company. Get interested in what they're doing, have an interesting conversation, connect with them personally. This is, and then you can follow up later with more details about your company. That's my advice.
We have a question from Alexander. Dear Steve, how much would be your fee? But I think we should maybe just connect you directly to Alexander. And
so there's There's two ways to work with me, right? If I'm doing in the program that we're putting on with Daniel, the GoUSA program, there is no fee for you. Like during the program, you don't pay anything. So you come in and you literally whatever you arrange with GoUSA, it's done. I don't charge anything additional on top of that, and I won't. Later, if you come to me after the program, or you're not in the program for some reason and want to engage with me, although I encourage you to be in the program, at least first, you'll get a lot of value out of that. Then you can contact me directly, and I would let you know how we work as consultants.
Sounds great. Last question, I think, because we are a little bit over time already. You said we shall sell the vision, but at the same time, investors want data and see traction. How much time in percentage I should talk about vision versus status quo if the customers are not ready for the final step of the vision now, but need to get there step by step due to typical fear of large change processes inside large organizations? And the first 1 or 2 steps that are already done and have traction. Hope the question is not too complicated.
So let me say, traction is extremely important. So first of all, they need to understand your product. They need to understand your customer and why your customer is buying. That's the first thing. Second, they need to understand the traction that you've gotten, right? The traction and data. And then the third thing, I just said vision because people forget that it's not just about what you're selling and doing today. It's about what you'll be doing not even tomorrow or next month or in a year from now, but 5 or 10 years. Just include that. Percentage of time, spend most of your time in on the first things I mentioned, on explaining your business, explaining your customers, explaining your traction. That should take up at least 60% of your pitch. At least 60 should be on that. Then you have 40% for everything else. You know, the big slides about, marketing, your team slide, your competitor slide, your vision slide, all of that is kind of equal. So the vision part actually doesn't have to be that big. It depends how long your pitch is, but the vision part can be pretty short. But do include it and make sure that it's in there. But it doesn't have to be a huge part of your presentation. When you come, a big part of what we'll be doing is working on these presentations with you and making sure that you can fit everything into first a 5-minute presentation, because 5 minutes, it's much easier to make a long presentation than a short one. Like short presentations are really, really hard to get everything in. Long presentations are super easy. So once you get the short one, it's super easy to expand it. So we're gonna laser focus on how you get everything into 5 minutes, all the key things and how long to spend on each thing. And then of course you can do longer presentations in the future if you want to.
I think we have 2 more questions, but we will just answer them together, I think, after the webinar separately, because we don't want any questions, of course, unanswered. But I think for today, we've already stretched our time and your valuable time as well, Steve, so much. So thank you for being with us. It's great to have you as a partner for the Go Silicon Valley. Looking very much forward to our next projects and to the departure workshop in Vienna. So to all our audience, have a great night.
Look forward to seeing you in Vienna.
Good night. And for us, the day is just about to begin. Thank you so much for being here. And we'll keep you posted about the next GoUSA startup talks.
Okay, great. Thank you.